But I think we'll make a start. So good afternoon, everyone, and thank you so much for joining us again today. For those of you who are new to our webinars, bit of background about myself. My name is Kate Clark. I am the founder of Artemis Clark, and I'm an accountant by trade, and then turned to the dark side and basically source senior level finance professionals for scaling businesses. So think of head of finance, finance director, CFO, whether that's permanent, full-time, part-time, or on a fractional basis. And we started doing these webinars last year with a view to actually wanting to give some sort of value to our audience. As I said, being scaling SMEs. And sometimes these webinars are sort of more technical. Other times, they might be to do with sort of resourcing, recruitment. But today's one is to do with actually sort of funding, which I find is a topic close to many a founder's heart. So I'm delighted to be joined by Ben Donati, who I recently met at a networking event. And when he started explaining where he was from, I'll let Ben do an introduction in a minute. I thought, yes, I must have him on one of our webinars to come and, sort of shed the light on sort of some alternative sources of funding that you might not be aware of outside of your bank. So I'll hand over to Ben to do a bit of an introduction to himself and FW Capital.
I'm Ben Donati, Investment Executive at FW Capital. I'm also an accountant by trade, 6 years in audit, training at the Big Four. And then a couple of years at regional firms here in the Southwest. Kind of had a completely Southwest-based career, FTSE 100s all the way through to startups, local SMEs, seen kind of the whole range of the market. And I joined FW Capital back in May last year, ready to move over to the dark side, away from accounting. And have a real opportunity to help the local SMEs in the Southwest, do something really material for them. So FW Capital are a regional fund manager. We essentially look after a number of funds across England and one in Wales, and mainly they're British Business Bank funds or pension funds. And our purpose is essentially to help deliver those funds, get money into the local economy, help support those local SMEs. We set up in Bristol in 2023, around July time, with the sole purpose of delivering the Southwest Investment Fund, which is what I deliver down here in Bristol. And the Southwest Investment Fund is a £200 million commitment from the British Business Bank, which is essentially the government's economic development bank, to help bridge a bit of a funding gap, especially in the regions of the UK where there might be the traditional institutions aren't quite able to help and be able to support those businesses. We can come in and kind of take a look. It's split into 3 different delivery methods. So you've got small debt, which is 25,000 up to 100,000, delivered by Swig Finance, who do a great job in that sector of the market. You've got equity finance, which is delivered by Maven Capital Partners. And again, they'll do equity investment of up to 3 million in one go and up to 5 million in a kind of total investment. And then where we sit is we do the large debt. So we do 100,000 up to 2 million of debt, typically over 5 years on a fixed interest rate, which kind of, it's on a risk-based matrix, the pricing. So it's all very personable, and we kind of look at every deal on an individual basis. And we look after the north of the Southwest, so it will get confusing with the norths and souths and splitting the region. So we look after the north patch, which is your Bristol, Bath, North Somerset, North East Somerset, going up to Cheltenham, Gloucestershire, across to Swindon and Wiltshire, down to Marlborough and Salisbury, and that kind of area is where we mainly look after. The lower, the deep south, the Devons, the Cornwalls, the Dorsets, that's looked after mainly by the FSE group, who do the equity and the debt down there, and then Swig Finance, who do the small loans down there. So that's essentially an overview of the Southwest Investment Fund and what we're doing here to deliver it. We've got until 2028 to get the cash out the door. So plenty of time left, plenty still left in there. So we're just looking to support those growing SMEs in the Southwest.
So basically, in layman's terms, then, for people that don't necessarily understand sort of the concept of a fund, essentially, you've got a great big pot of cash that you have permission to invest in certain types of businesses.
Absolutely.
And you want to get a return in terms of interest payments on those loans. You're not doing the equity bit, you're doing loans.
Yeah.
And there are certain criteria that those businesses need to meet for you guys to invest that money into them. Yeah.
Exactly. And we're a commercial fund. So like you said, there is an interest rate. It's not kind of grant funding from the government where it's just given out on that type of basis. It's a commercial basis. You know, we're looking to generate some returns and sensibly and responsibly invest to make sure that the cash can go out for, say, 5 years, have a really, really good impact, generate some jobs, stimulate the economy, and then come back sustainably. Really, that's what the purpose of the fund is.
I know that you've obviously covered that you guys are sort of Southwest, but FW Capital, it appears like, covers a lot of the UK from sort of my research on your website. But I think when we originally met, you said not London because the Southeast isn't perceived to be an area that needs economic stimulation. Just for people watching, if you're in the Southeast, then you might want to switch off now because this sort of funding isn't going to be available to you. Is that correct?
Yeah, absolutely. It's kind of the view of the government and the view of the British Business Bank that they had a look at the UK and they said, right, you know, where do we need to give it a little bit of a boost? Where do we need to stimulate it? And they basically concluded everywhere but the Southeast. So you've got the Southwest Investment Fund, which is obviously down here. You've got the Midlands Engine Investment Fund, which it covers all of the Midlands. You've got the Northern Powerhouse Fund, which a lot of people I think might have heard of, which FW Capital are also delivering up in Manchester. You've also then got Investment Fund for Scotland, which does what it says on the tin. Investment Fund for Northern Ireland, again, an Investment Fund for Wales, which FW Capital are also delivering. So we've got a few of the funds, which I think shows the British Business Bank's belief in our ability to deliver those. We do have a few of them that we're delivering across the UK, but they're split between many fund managers.
Okay. You briefly touched on it, but if you could maybe just elaborate a bit more on the typical types of businesses that you support, and you know, I think we've already covered, you know, the types of funding you provide in terms of it is debt funding, but maybe just a little bit more about sort of, you know, the types of businesses that you will support.
Yeah, so we're looking to support growing SMEs based in the Southwest. That's the headline. That's the who are we looking for, and the way that breaks itself down is any sector. There's a few that we're not allowed to do, like gambling, anything that might bring the government into disrepute, and some other niche things, like if it's already a government subsidized sector, so something like shipbuilding, but I'm not sure there's too many SME shipbuilders flying around, so it's not usually too much of an issue. So any other sector, we see a lot of recruitment, a lot of digital marketing, hospitality, anything you can really think of. That's who we're looking to support. Those businesses that have a management team or even just a founder, director with a vision who wants to go out there and do something, believes in their business, believes in taking it to the next stage. That is what we look at that and say, right, we want to have this conversation. We want to see what we can do. That's the big thing is, you know, we're not supporting businesses in distress. So we're not able to do kind of loss-making businesses who might need cash to help keep them afloat. That's not the purpose of the fund. The purpose of the fund is those EBITDA positive and kind of profit-generating businesses who are looking for a capital injection to hit that next stage and supercharge growth. That's who we're looking for. So it's really quite broad. It's you know, do you believe in your business? Do you want to take it to the next stage? Are you growing? Are you based in the Southwest? Yes, then we'll have that conversation.
And so you sort of you touched on sort of looking at like the profitability side of things, but if someone is really at the pre-revenue stage, would it be dependent on how much you believe in their idea as to whether you would give funding, or do you need to see some traction at least to see some profitability coming through? So like how many years of trading would you want to see typically?
Yeah, so if you're pre-revenue and you're just starting up, I will be more than happy to send you over to Maven Capital Partners and put you in touch with Luke, Mel, Rafi, and Katie, and say, you guys have a chat with them. You know, you're looking for equity, really. That's kind of what I would say. And you know, it's no one's fault that they might not know the correct type of funding. You know, it's a confusing market, right? So that's what we're there to help guide people, point them in the right direction. So in terms of years of trading, it's not really material to us how long you've been going for. It's mainly about, are you showing that you have a sustainably profitable business at the heart of what you're doing, that we're essentially just adding and boosting. And you know, you could be going for a year and a half, you could be going for a year, but if you've had a brilliant year and you've shown that you've got something that works here, we would be happy to have that conversation. And equally, if you're a family business that's been going for 35 years, that's absolutely fine. We would also more than welcome the conversation. It's about attitude, mindset. Do you have a good underlying business, rather than just having strict policies on it needs to be X, Y, Z years old or anything like that. That's mainly what we're looking for.
Okay, that makes sense. Now, you mentioned that you wouldn't be interested in sort of loss-making businesses, but what about a business that, let's say, has got a track record of being profitable, and maybe has been under new management, and during that time things have slipped, but now the management has been exited, a lot of the costs that have got out of control have been addressed, so you kind of can see that they are now at a point where actually, you know, they can go back to being how they were in terms of like cash generative, and they've got that traction. Would that sort of business be of interest to you, where you can kind of see that they've addressed it? They're not coming to you kind of going, oh, we've only ever been loss making and we need to fund our working capital sort of thing. It's more about like actually maybe taking the eye off the ball and has then addressed issues, and then you can then see that they've then got that potential for growth. Would that sort of business be something that you would consider, or is it?
Yeah, so the way
one?
that we would approach that is I kind of look at it as a bit like, are you currently still loss making? If so, we'll still have the conversation. We will have a Teams call, a meeting with any business that approaches us. We'll get to know what's going on, and we won't ever just, you know, send a rejection email and say no, not for us. We'll speak to everyone. If they're still currently loss making, it would most likely be too early for us.
Yeah.
If it was at that point where they've gone, right, we've got 3 months of profitability, we've shown that we're starting to make that change, I would say, okay, let's keep in contact. Let's have some monthly communication. If you're happy to just send me your monthly management accounts, and so that I can just keep an eye on it. And then when we get to 6 months and we go, right, we've got 6 months of good profitability here, we've clearly turned the corner. You know, we're a new business. Everything is going well. I would at that point then be interested in having a go, but probably on a smaller amount. So, like I said, we do that 100,000 up to 2 million. If it's that type of business, I probably wouldn't be looking to do anything more than a maximum of probably 250. Okay. Purely for exposure and risk purposes, because we would look at that and say it's a risky deal, right? If they've only got a few months of profitability, or even if they get to that 6 months point, we'd still say, you know, it's not a business that has got 5 years of just consistent, strong, good profits that we can look at and say, right, that's a business that we can comfortably lend 7 figures to. You know, we would say, let's start with X amount, with a view to then following on, which is something that we can do. And we do quite regularly is cash can go out the door on day one, but that's not the end of the relationship. That's just the start, really, where we can say, right, we're a further 6 months in. Let's do another 250. Let's do a 500,000 at this point. That's the flexibility that we have. We just find that it's good to get the foot in the door with potentially a smaller amount to start with, see how they get on, see how they execute that cash, and then say, right, let's pop a bit more in. That's how we kind of look at a situation like that.
Okay, no, that makes sense. I just sort of like breaking it down a bit further in terms of why businesses come to you for funding. Obviously, that it's for growth, but can you sort of give a bit more detail in terms of the typical sorts of things that they are sort of saying that they're going to be spending that money on?
I'd say the biggest one is headcount.
Yeah.
So new members of staff across all levels. We've had people say, right, I need a head of finance, I need an FD. We've had people say, well, I just need a new customer services representative.
I know someone who could help with the FD.
if they're looking for that FD and that CFO,
then
you know
yeah.
who to go to. So I'd say that's the biggest one. And we've been going for nearly 2 years here now in the Southwest, and we've had some numbers back on jobs that we've created for our portfolio companies, and it gives you a real sense of pride that you can look at that and say, we've
created that.
X amount of people have now got these jobs off the back of this fund. So I'd say that's the biggest one. It is headcount, but a lot of the time it's also a capital purchase. So it could be buying a new big piece of machinery, fitting out a new office. We see that quite regularly, or fitting out a new restaurant or a new cafe, or it doesn't have to just be we need to hire loads of people. It can be other things that are a bit more one-off, kind of, right, we've made this purchase, now it's going to start generating us profits over the next X years. So, it makes sense to borrow some cash to pay for it. And that's what we see that the main thing is for, and entering new markets, marketing, product developments, anything really. But I'd say the main ones are new staff and kind of fitting out a new premises or helping to open a new location. I think are the biggest ones.
And what about if someone is sort of doing a bit of a buy and build strategy? What are your thoughts on that in terms of providing sort of funding to then go and acquire sort of other businesses?
Yeah, we've already got one that we've looked at like that is in our portfolio, where it's it's all about the management team. I'll say it again. It's about the attitude, the mindsets of the management team, and are they coming in and just saying, I want to borrow £1 million. I'm not putting any of my own money in. I'm just going to buy these businesses and just see what happens. I've got no experience in the industry. I'm just going to borrow a load of money and just give it a crack. At that point, it's a no. It's probably a no from us. If it's people who have good experience in the industry and they've gone, right, I want to have a crack at doing this buy and build, they're putting a bit of money in it themselves. Sure, that they're borrowing, say, 500,000, but they might be putting 100k of it in themselves. That's always a big green flag for us, where we look at that and say, right, well, they're willing to put something on the line, right? Rather than just wanting to borrow it all and just give it a crack. And like I said, it's an industry experience, putting a bit of capital in themselves, showing that they've really, really thought about it, and not kind of just coming in and saying, well, this person's selling their business and they've got it for sale at this price, so I'm just going to give it a crack. It's, have you really made a bit of a plan and gone, really analysed it, had a look at the market, X, Y, Z. It's that's what we like. And we have had some people that have come to us and just said, yeah, can I borrow £500,000 to buy this business? Oh, it's a cleaning business. What's your background? Marketing. And it's, well, not saying it's not doable, just saying, let's have a think.
To be fair, I wouldn't, from my experience, and we work with a lot of SME business owners, the ones that have that marketing background from when they've been in the corporate world or whatever, are the ones that generally do very well, because like ultimately, you could have the best product in the world. If you can't market it, you won't get anywhere.
Yeah,
So I've definitely
absolutely.
noticed a correlation.
Absolutely.
This is why I've been retraining to understand marketing for like the last sort of 6 to 9 months, because it's that key thing in terms of
Yeah,
like
absolutely.
having the understanding of how to market your product and service is so important. So no, that's really, really interesting. So you touched on your investments go from sort of minimum of 100k up to sort of 2 million. And I think when we spoke prior to doing this webinar today, you sort of mentioned that you would ask for sort of different levels of documentation, I guess, depending on how much funding they are looking for. So at the sort of the minimum at the 100k, or also a supplementary question to that, which sprung up just now in my head, was when you're looking for investment from the founder, do you have a percentage in mind? So if they're, let's say, looking for 100k, are you looking for like 10% of that they've put in, and likewise up to the sort of the 2 million? Is there kind of a guideline in terms of what you would expect to see? So sorry, two questions there, really.
Yeah, so I'll touch on that second one first, because it's a bit of a quicker one to answer. So we don't really have any. We wouldn't expect someone to put money in if it's something like, say, hiring staff, marketing, that type of thing. We wouldn't expect them to put any money in. It would only really be for an
The
acquisition
acquisition.
or an
Okay.
MBO or something where
Okay.
we might say we'd look for them to also contribute.
Okay.
What's similar to that is the it's kind of this, but it's also kind of not. Is as part of our security package, we do typically have personal guarantees. So that's kind of similar to saying putting their own money into the business, because it is kind of putting some of their personal wealth on the line. And that's every deal we do will have an element of a personal guarantee. It fluctuates. There's no rule. There's no percentage. There's no, well, Joe Blogs did it, so you have to do it. There's a lot that goes into it. How much have you already put into the business? How much do you have on the line? How long has it been operating for? What's the value of the balance sheet? Do you have a lot of assets to back it up? There's a lot that goes into it. So that's what I would say is the most equivalent thing to them putting their own money into it, is kind of them putting their own money on the line. But that's of course only in a worst case, absolutely worst case scenario. That's not something that anyone wants to have to actually do. It's more just a bit of like a protection for us, and a bit of a if things look like they might be trending downwards, it's a bit of a reminder potentially to say, well, you can't just throw in the towel and call it a day, right? It's let's actually get this business back to where it was, back to what you've been able to do before, and everyone will be happy, and it will be smiles and sunshines then at that point. So that's what I'd say is the most equivalent. In
Okay.
terms of the information, it will fluctuate between kind of how much we're looking to lend on a smaller deal. So we'll say 250 and below. We're looking for a bit of a verbal business plan, just a bit of a right. This is what I want to do with the business. This is what I want to do with the money. I'm going to hire this person. They're going to be a business development executive. I want to hire a new finance assistant. That's what we want to know, and they'll have in their mind how much they think that will cost, and therefore how that correlates into how much they're looking to borrow. That's what we look for on a smaller deal. On a bit of a larger deal, so kind of above that 500,000, approaching 7 figures, we want quite a comprehensive business plan where you're kind of it might be in a deck, it might be in a good PDF where it's written down. You've really thought about it. You've got, right, this is definitely what we need to do to reach the next level. It's going to cost this much. This is my background as a founder. This is my co-founder's background. We've worked for this many years doing this many things at these companies. Here's the background of the business. We started it then. We hit this milestone there. We did this there. It might sound like a lot, but it's all stuff that they should already know and should already
Yeah.
be quite passionate about. And kind of, if you're coming to someone and saying, I want to borrow £1 million, you should be shouting about yourselves from the rooftops, right? And saying, yes, look at these milestones that we hit. That's something that's important on that higher level. And just from a kind of blanket, all deals, we'd want to have a look at some up-to-date management information that's decent quality, that's not just cobbled together, something that has been put together with a decent amount of care. On those larger deals, sure, we want a bit more of a sophisticated model. On some of those smaller deals, the MI can be a bit elementary. It doesn't have to be game changing. 3 months bank statements, again, any size of deal, we want to have a little look at what's going in and out of the bank. What other debt do you have that you're repaying each month? What's your payments like to your suppliers? Do you have anything in there going through that you shouldn't? That type of thing. We'll just have a look and analyze 3 months, and then forecasts. This varies. So if it's below 500k, if it's 500k and below, a 12-month cash flow forecast, again with varying levels of detail. If it's 100,000 deal, I'm not going to say, right, go out and spend 10 grand getting a really sophisticated model together, with all the bells and whistles. But if they have that already, then absolutely brilliant. If it's on that 500k, 300k mark, again, still only a cash flow, but we might want to see some assumptions. We might want to see it, you can tweak it a bit, you can put some inputs into it, that type of thing. And then above 500k, we need a bit more sophistication. So we'll need three-way integrated forecasts, so balance sheet, P&L, and cash flow, just for 12 months. But again, once you're getting into that over £500,000 of borrowing, it's a different ball game. If you're asking for £750,000 from someone or from an institution, you should be coming prepared and coming with information that you've got ready to show, ready to put their mind at ease. That's what I'd say.
And I'm assuming that in that cash flow forecast, you are expecting to see your loan going in and then the repayments coming out, so that you can then see the affordability within that model. Yeah.
You'd be surprised how many come to us without it in there, and I come back and say,
I wouldn't, but
come back and say, well, are you forecasting it to come in or not? So a few times where we've gone back and said, don't forget to pop that in X month or whatever, and build it into your assumptions. But the more savvy ones have it in there. But we give a gentle reminder, that should be in there.
Okay. No, that makes sense. Now, I gave you obviously a bit of homework before doing this webinar, and I think you've got a very nice example, because a lot of business owners won't necessarily know what is expected of them. They hear the term business plan. Well, what do you mean by that? So, I see a lot of presentations, because I'm sort of an angel investor, so I've kind of got a good concept. But what you've prepared, I think, is a really nice example of the sorts of things that you would expect to see in a decent business plan. Obviously, as you've alluded to, then you'll talk it through in a minute, but in the numbers bit, those numbers have to be supported by management accounts, and in the case of the forecasting, a robust financial forecast, which actually gives me an idea for my next webinar. I think I'll sort of demonstrate how to put one of those together, because that's where it becomes tricky. So if you were able to bring it up and just share your screen, it would just be good to really sort of just demonstrate what you would be comfortable with.
Absolutely. Let me know when you can see it.
I can see it. Just if you put it onto the slideshow.
Perfect.
Perfect. I can see that now. Yeah.
So this is a template that I've fiddled with and kind of put in some relevant bits. So John Smith and Jane Green are fictional. ABC Limited, I'm sure, probably does exist, but not this one. So this is kind of just a decently short, not anything with groundbreaking detail. But I'd look at this and say, this is a good starting point and a good supporting piece of information for a bit of a bigger deal. Someone's asking for say 7 figures. I'd want to see something properly prepared and put into a slide deck or a comprehensive PDF. So we're kind of just starting with a bit of a mission statement, just a bit of right, what do they want to do? What's they give you some nice buzzwords in here, but we'd expect them to have some sort of mission statement. What do you want to do? What's the business? What's it trying to do in the world? That's kind of we'd want to know that. And then one that's quite important, talk about the management team. This can be the whole board of directors. It could just be if you've got two founders, or you've got a founder and some advisors, and even if it's a bit of a smaller SME, and it's maybe you've only got 4 employees, so you can pop them all up there. But what we want to know is who are they, what's their role, and a little bit about their background. So again, it's just giving us a bit of a flavor of them. So it doesn't have to say, I worked for 5 years at this company, and then I went on to do 2 years at this company, and then I did the checkouts at Sainsbury's for 6 months. It's kind of,
it's just high level.
Exactly. You can look at that and say, right, this guy's got 30 years of experience working in this industry at large firms. Great. I'm going to drill into that a bit later, but it doesn't have to be spilled out onto there. And you look at them all, and you've got the high level, you've got what you want to know, like Greg. It's you want to know that Greg as an FD has some sort of something to him, like an ACA, an ACCA, a CIMA, the tax one, whatever
CTA.
it is. Yeah, CTA. You're going to want to know that he's potentially got something like that, and what have they done? That's what I'd say. Again, nothing groundbreaking, but it's showing you the high level of their skills and what they bring to the table. And then this is just really straightforward. This is, again, if you're a bit of a bigger business and you're looking for a bit more cash, you're looking for that $1 million to 2 million, something like that, you'll probably have a wider team, and so you might look into it. So again, because this is a kind of like marketing-y type business, it focuses on, right, who's kind of leading this, the team that the cash is going to go into, and then who are they looking after. This doesn't have to say, Felix has got 1 billion years doing whatever. This is just kind of, right, here's the team, and then I might later down the line want to drill into Taylor's background a bit more, and but it doesn't have to have all the bells and whistles there. Okay. And then just moving on to a bit of a market summary. Again, it doesn't have to have loads of text there with loads of things and just massive paragraphs of loads of information. It's kind of, right, what are the things that I need to know? What are the things that I can kind of look at and say, that makes sense, I like the idea of that, that's relevant, so it's just little bits here that get you interested and say, yeah, I agree with that sounds good, let's move on. So then move on. Again, it's a bit similar, it's kind of saying, here's the opportunities, we've got a few things there, a bit of market research, that's always really useful. Just a bit of market research where you've clearly gone in, put some effort into it, gone and had a look at some online figures, pulled something in that backs your case. So I read that and say, that makes sense. I feel more comfortable lending them some money, because we kind of have to become a bit of an expert in someone's business in a very short period of time, and an expert in a sector that we might not have had that much exposure to. So it's just nice to have that bit of extra information coming into the business plan, and then usually a bit of an overview, and then again, just the thing that they might want the cash for. Really quick concept, just something there that grabs you and says, right, I'm gonna down the line ask a load of questions about this. I'm gonna get to know it properly. I'm gonna dive into the details. I'm gonna do this. I'm gonna do that. But again, from a business plan point of view, I kind of just want to know that it's relevant, that it's a good concept, that I like the idea of it, and that I think it's something to pursue. That's the main thing. Is it something that we can pursue? If it's got a load of text and loads of everything, but then I look at it and I go, well, actually, that doesn't quite sound right for us. It's a lot that's gone into it for quite a quick kind of dismissal. So it's quite I quite like that, and I think this is probably my favorite part of any kind of business plan is a timeline, and they can be missed out from some, but I think that this kind of just shows you. It says, here's the highlight of everything big that's happened. Here is everything that I really want to scream and shout about, that I can put on a slide and just, as a founder, as a director, I say, right, what was that contract that you won in 2022? And they go, oh wow, this was with this major corporate company. The team worked really hard to win that. We've still got them, and it does X amount of revenue for us per year. It's that's what I want to know is, a timeline where I can just look at it and say, right, it's growing.
Yeah.
Yeah, exactly. It's growing. I'll say, how did you manage to reach that EBITDA level in 2021? What did you do to reach that point? That's this, I think, is a really, really important slide that I think can get missed off. People are always really, really, they already know it in their head. You say, what's the biggest thing that's happened in your business? They'd say, yeah, when we hired when the team got to 5, or when the team got to 30, and blah blah blah. But put that on a slide, shout about it, say, really just make a big deal of it. I think is important in my eyes.
Okay.
And then always relevant financials. Again, I'm not a huge fan of having loads and loads of metrics with a billion different graphs and charts, and kind of something where I look at it and I go, oh, I need to really think about what the hell's going on here. It's kind of like, these are our key metrics. This is how many customers we had. This was our retention rate, keeping these customers going forward. Look at it. It's improving as we're getting better. Customers are growing. Therefore, the revenue's growing. The profitability's growing. I look at that and I just go, right, I like that. I liked it in 2021 as well. That looks good in 2021. But you look at that and you look at the growth and you go, wow, there is a business here that is booming. What could it do if I put £2 million onto the balance sheet? What could they do? Going forward. That's the thing for me. It's you look at it and you just go, wow. What can they do next?
So, obviously, behind those numbers, there's going to be financial information. At what stage do you then dive into those numbers to then potentially do adjustments to EBITDA? Because obviously, if a business owner is only paying themselves the minimum amount of salary and then doing a said load of dividends, that EBITDA number is going to be skewed because obviously the dividends don't show in there. So at what stage do you then go into the finance model or the management accounts, whatever it is in terms of forecast or whatever, or reality in this case? When do you then look at that information? Because obviously at this point you're like, oh, that looks really great, but if they've paid themselves, well, I guess but two questions really. One is, when do you do it? And two, obviously, if they've paid themselves a massive dividend, but actually to then be sort of, I guess, is more applicable if a business is being acquired, because you would then replace that person with, the CEO or whatever, and then the salary might be adjusted down because actually they won't be having the same salary as the dividends that have been paid to the founder. But yeah, I guess the two questions are, one is, when do you dive into those numbers, and then two, what adjustments do you make typically?
Yeah, absolutely. So if it was a case like this where we've had this business plan come through and I look at it and I go, wow, I really like that, I would then follow up and say, looks great on the face of it. I'd like to take it forward on the basis that I can receive some up-to-date management information, some up-to-date management accounts, a couple of years of the statutory accounts, just to see how it flows into the actual accounts that get reported. And then at that point, I would start, I'd put my accountant hat on and I'd start digging through, and I'd have a look and I'd go, what are they taking as dividends, right? So we'd look at that quite early on, because there's there's nothing wrong, absolutely, with taking dividends. That's a tax efficient and very common way of remunerating shareholders. We just have to make sure that it's sustainable. So we look at an EBITDA figure, and for our affordability and for our covenants and everything like that, we will adjust EBITDA to take off dividends. So, on that 2024, if they have remunerated themselves with 600,000 of dividends, we would say that your adjusted EBITDA is £500,000, purely because it's cash out the door. And like I said, there's absolutely nothing wrong with it. It's essentially, is this a lifestyle business, or are you actually really looking to take the business to the next level and grow it, and potentially be willing to leave cash in the business and not take it all out as dividends for the sake of the business's growth? If I've looked at plenty that have been really, really good businesses, and they've gone, yeah, you know what, the last 4 years it's been a lifestyle business. I've taken pretty much everything out, but I'm up to date with HMRC. I've never had issues with my payroll as a result of taking the cash out. I've never missed payments to suppliers. I look at that and say, why wouldn't you? Why wouldn't you take the money out that you've earned? And then they'll say, but now I'm ready to really grow this business. What do I do? And then we have that conversation on, you can absolutely still remunerate yourself by dividends at a sustainable level that makes sure that you can still comfortably hit your debt repayments. That's the main thing. Is we're never going to say, right, stop taking dividends, stop paying yourself. It's, let's do it at a sustainable amount that means that you're keeping some money in the business and there's no strain on repaying us and that sort of thing. It's just a very pragmatic conversation that we have, and we'd never blindside a director, shareholder or founder by saying, they've signed all the documents and then we say, oh, no dividends now anymore. That's not how it works at all.
Okay, no, that makes sense. And just one supplementary question, where you sort of talked about getting management, information management accounts, etc., and then obviously reconciling them to the statutory accounts, which I imagine is a challenge in many cases, from what I've seen. But in terms of the management accounts information, what is the minimum that you want to see there? So P&L is obviously the common thing, but are you looking for balance sheet? Are you looking for a financial summary talking about like key trends and stuff, like monitoring of their KPIs? Are you looking for like the cash flow forecasting within that as well? So just maybe quickly sort of touch on that if you wouldn't mind.
We really need balance sheet and P&L. That's the two where we look at that and say, right, that's what we need. For two quite straightforward reasons. We need the P&L because we need to see the profitability of the business from a recent point of view. We look at historic statutory accounts and that's great, but we want to see something, where are we now? Kind of start of June. I'd potentially want to see some management information to the end of April and say, how's everything been financial year so far? And we'd also use that to gauge our affordability. We'd look at that and say, yeah, good profitability. We think that, extrapolated annually, you're on track to do this, and therefore we think you can borrow this. Balance sheet, really useful because, pardon me again, it shows the net worth of the business. Pardon me. Shows the net worth of the business, what's left in reserves wise, and the value of the assets. Excuse me.
I'm going to take the opportunity to take a drink as well.
yeah, absolutely. We can see the value of the assets on the balance sheet that we would then use to help gauge our security value. So what's your level of debtors? How much stock do you have in the business? That type of thing that we would use to see how valuable our security package is, really. Those are the two most important.
Which ratios do you look at then typically? Because I always like the current current ratio, but did you actually kind of dive into the ratios?
We don't really, look at ratios and say, you
Interesting.
need to have this amount of the ratio. We kind of look at it from how much money are you borrowing? What's the value of the balance sheet? So it's essentially because a debenture or a charge at company's house kind of has implications of what we might be able to do in a failure scenario, and kind of who's put at the top of the list, and who has what rights to assets. And essentially your trade creditors and everything like that are pretty low down in the list, especially if there's a debenture. So what that means is we don't really have to look at those types of liabilities.
Yeah.
We can kind of just look at it and say, well, they might have 400k of trade creditors, but in a failure scenario, that they're one of the last to get paid. So that's why we don't necessarily look at ratios. We would just look at a written down value of assets. So trade debtors, we typically write that down to about 70% of its value. Stock, we typically write it down to about 30% of its value. And then fixed assets, we would write down all the way to 10% of their value, because it purely reflects the, if we actually had to come into a business and, start taking the tables and chairs out, what are you able to recoup? But again, these are all kind of the real bottom line scenario that you don't want to have to do, but you have to think about it, and everyone has to be aware that is a process, even though you hope on every single deal that you never get to that point.
Just on that earlier, you mentioned about recruitment businesses, and I remember when we first met, I was surprised about that being a sector that you were happy to invest in, because obviously you don't have much in the way of assets, you don't have any stock, etc. So you must be looking for a certain amount of trade debtors then to feel comfortable investing in those sorts of businesses. Is that correct?
I mean, not really.
Okay.
It is also dependent on the level of personal guarantee. So I'd say on something like a recruitment business, one that if you've got good people like yourself who know what they're doing and are good at knowing the market, they're usually really good businesses. And what that means is that the founders are quite often quite happy putting their money where their mouth is on those. So there might not be any assets per se. There might not be a massive balance sheet, and all that's going to be on the fixed asset register is going to be maybe some laptops, some tables and chairs. But I might say do a 250k deal, and they might say, well, I'm going to personally guarantee 125,000 of that, and then we'll kind of top it up with whatever's on the balance sheet, with whatever debtors are there. That type of thing is, because they don't own anything, usually we would rely on more of a personal guarantee basis. But we haven't really seen many issues with that, because like I said, it's usually strong founders, strong directors who know what they're doing and are happy to put their money where their mouth is.
And then when you're going down the personal guarantee bit, do you then need to start looking at my assets? So you need to then look at my personal wealth to kind of know that I can put my money where my mouth is?
Yes. And
okay.
It can feel like a very intimate process, and you're kind of getting into someone's personal wealth, but behind the business. But the point is kind of, if we're lending a lot of money, we just need to be sure on everything. It's a bit like, you wouldn't get a mortgage without showing the bank your bank statements, or that, or your pay slips or whatever. It's a bit like, if someone is doing something for you, this is kind of what you're doing in return for them. Because we don't want someone to go, oh well, I borrow £500,000, I'll personally guarantee all £500,000, and then actually their personal wealth might not be able to back that up, and that's why they're doing it, because they're like, oh, it doesn't matter because I don't have it anyway. So we'd usually just have a look, and you don't have to be a homeowner. We're not, and these are unsupported personal guarantees, so we don't have any direct recourse to someone's personal residence. We're not they're not the type of personal guarantee where if something goes wrong, we're coming in and saying, get out of your house, whatever, it belongs to us now. That's not at all what it is. It's all a very sensible, pragmatic approach. If that was to come to it, you have to think about it, but you don't want it to come to it. But we would just make sure that the personal wealth backs up what they're saying. But even saying that, if you've got a business with a lot of intellectual property or something like that, we can take a bit of a view, and if someone's doing a personal guarantee that they might not on paper be able to back up, we might be able to take a view that says, right, well, this business has a lot of intellectual property behind it. It's got a good contract book. It's got that black book of customers. What would happen if things went wrong? Well, they'd probably get acquired. So we might look at that and say, actually, we're still happy to do this, because in that scenario, they'd probably get acquired and they'd probably sell. So there would be some proceeds to cover the loan. It's just all about having a pragmatic approach, and every deal is different.
Okay, that's cool. I'm conscious of time, and I'm also conscious that I've kind of stopped you midway through showing the business plan. So I'll let you carry on with that, and then I've got a couple of things to wrap up. So
there's not much left. So we kind of just got here, kind of end bit of a summary, just with a few strengths, few challenges, something for you to think about. Again, nothing too groundbreaking, but something at the end where they're going, this is why we need the cash to do this. This is what we're good at. We've got a great reputation in the market. Our leadership is really experienced. That's pretty much it. I'm not expecting anything that's going to completely revolutionize the world of business plans, but just something that's kind of gone, I've put effort into this. I've thought about this. That's what I would say pretty much.
No, that makes sense. That's cool. Just a couple of questions to finish off then. So what would you say would be sort of red flags to you that could delay or derail an application? Obviously, apart from the obvious not having a little business plan there, what else would you say?
I would essentially say that the red flags and something that might derail it is not knowing how much money you need in the first place. Kind of maybe just thinking, oh well, I'd like some cash, but not really thought about it too much. I just kind of want to come and see how much I can get. Something like that is a bit like, come on, let's think about this properly. And on the back of that, asking for too much, if you're just coming in and saying, oh well, £1 million is possible, so I'm going to come in and have £1 million, and you go, right, what do you need it for? And they say, well, I need to hire this person, that person, or do a bit of marketing, and you go, oh, I can't really see that costing more than 300k, right, or something like that. I'd be thinking, well, where's the rest of the cash?
Where's the rest going?
But then on the other end of it, I'd also say asking for too little. If you can afford and the business could take on $500,000, and you're saying, I want to overhaul the leadership team. I need to get an FD. I'm gonna speak to Kay, and I'm gonna get an FD in. I need to get a really experienced marketing manager. I need to do this. I need to get a new set of officers or whatever, a new premises, and it's gonna, that's what I need to do. And they go, but I just want to borrow $100,000, and maybe in the bank they've only got $50,000 or whatever. And you go, I'm not sure you're going to be able to do that for 150k, right? And that's an example where we might put some cash into it, and then 2 minutes later they come back and say, oh God, I need more. And that's when it's kind of like, we can do that, but we would like to do the correct, sensible amount on day one, rather than having to kind of, someone should come back to us for money because they've gone, right, I've implemented my plan, it's been brilliant, let's have a crack at stage 2 or whatever, rather than I've run out of money to do what I told you I wanted to do to start with. That's what I'd say. And just generally, just not being prepared, having no decent management information, not even a thought about a forecast or a budget, just coming in and going, well, I'm just going to see what I can do, see if I can get a few quid and kind of give it a crack. It's more like, no, we want to see that you've thought about this and that you've got the information. That's what we want.
And from your experience, I know this is a little bit of a plug for us, but from your experience, when is the right time to sort of think about engaging, a fractional finance director or someone who's got some sort of financial sort of advice, experience, financial consultancy experience?
I think it's when it hits that point. I think that every business is different, right? So if you can get advisors on the ASAP, if you've got the capacity and the cash flow and whatever, I think there's never any downside really to having good advisors and good skills in the team. But I'd say when it gets to that point where you're going, right, I really do need this person, is if we're looking at something and we go, right, I need some updated management information, and the founder who it might be recruitment business, and they say, right, okay, I'm just going to go and make that for you now then, or I'm going to go and get my MI together. And you go, well, hang on, you've been in tech recruitment for 20 years, why are you making the MI? You're borrowing £500,000 here. That's when I'd go, have you thought about getting a fractional FD on board? We're not saying go hire a CFO and pay them £1 million or whatever. We're saying get someone in, a day a week or whatever to do the books, a couple of days a week, a few hours here and there. We look at that and it's a massive green flag if someone already has that in place, or if they say to us, look, I know things aren't quite where they should be right now, but off the back of this, we are going to get someone in. And that can be a condition sometimes for us, as we say, we'll do it, but on the condition that you use some of the cash to get someone on board. Because, we have on larger deals, say kind of above 250, we're looking for monthly reporting. We're looking for monthly management accounts. We're looking for, debtors and creditors ledgers, bank statements. If you're a busy founder who's spinning a million plates running the business, you're not going to want us kind of going, come on, we need these monthly accounts done.
You just can't do it.
That's where we say, get someone on board who can give you a hand with that. They don't have to be in full time. They don't have to be doing, massively qualified at Big Four or whatever and done this and that. It's just like, get someone in who can give you a hand, help ease the burden from yourself. You need to go and do other things. Let the expert in that field help you and in turn help us. That's what I'd say.
Final question. So if we've got a founder who's got to the end of our webinar, congratulations. If they got to the end of the webinar, they're thinking about getting funding in, let's say, next sort of 6-12 months. What should they be doing now before coming to see you in the sort of 6-12 months time?
Yeah, so I first say congratulations for not being sick of my voice at this point. And then I'd say you've got to really want to grow. I think that's the first thing, is going, right, is this a lifestyle business? Is this something I'm happy to organically kind of pool along with for X years? Or do I want to grow? And if the answer to that is yes, I want to grow, I want to take this to the next stage, I want to go from 1 million revenue to 10 million revenue in 5 years, whatever, that's the first thing. Because you don't want to just do it and think, oh, I'll give it a go, whatever. It's, you've got to want it.
Yeah.
Get your finances in order. Again, if you're in the position to be able to do it, get a fractional FD on board beforehand. Get a finance assistant on board. Get someone in where you can say to them, right, I'm looking to borrow some money for growth in the next 6 to 12 months, whenever it might be. I need a hand getting decent quality MI, getting a decent bit of forecasting done. Someone to do the books who's an accountant. That's, I think, an important thing. So you've got to want it. You've got to get your information ready to send across, and you've just got to crack on, I think, with the business. Just don't take your foot off the accelerator. Just operate it how you're operating it. If it's already profitable and a good business, then just crack on. Just get everything ready. Get those bits of information ready, as I said. Have a think about what you want to do with the money.
Yeah,
do you need to hire a salesperson to increase sales? Do you need to hire a marketing person to help you get out there into a new area. Just think about, what do I need the money for? What's going to have an impact? And what will that cost? What will that look like? I think it's just all about being prepared, going into it, because it fills us with confidence when someone comes in and says, I need X amount for these people. They're going to cost this amount, and they're going to affect the business this way. They're going to drive this new thing I want to do here. You look at that and you go, wow, where can I sign on the dotted line? That's what it is, really.
No, that's brilliant. Just one final question, actually, and I know this will change over. If someone's watching this, let's say in a year's time, it will be different. But in terms of like how competitive you are versus bank loans, can you just give a flavour of how your rates compare? Because I think that's probably a question that most business owners would want to understand.
Yeah, absolutely. So we sit quite close to the bank's rates, really. So we operate on a risk-based matrix. Look at company credit score. How secured are we? And that kind of puts us in a bit of a range. And that range has a floor of around 6.5%. So that might be a deal we look at where we go, wow, this is actually a secured deal where they might have some property and some business property where they're letting us take a charge over it, a mortgage over it, and we'll look at that and say, it's a secured business deal. Let that we can go to that. We would top out around 12.5%, 13% fixed. And that might be the ones where there's already quite a lot of other debt in the business. There's already people who've got charges at company's house. So actually our debenture is worth having, but we're far down in the queue.
Below,
Or it's one of those ones potentially where it was loss making for ages and they've just turned the corner and we go, is it going to dip back down? That type of thing. But typical rate between 7.5 and 9.5, I'd say, is where we're seeing almost all of our deals are sitting in that nice range, which the bank are at those rates on an unsecured deal. We're not, I won't say any names, but we're not an algorithm-based lender where, you put your accounts in and it goes, click here for 250 grand. Oh, by the way, it's 18% interest rate. We will take some time to do a deal. We'll take some time to speak to you. We're not going to kind of look at something and immediately go, here you go, here's instantly £250,000 to your bank. But we're going to do it at a fair rate, and we're going to take a fair time to think about the business and the process, and that's where we are. The banks are doing a great job of servicing their market. We work closely with the banks. If it's something they can't do, quite often they will come to us and say, hey, this just didn't quite work for us, but they're a great customer. We really like them. Can you potentially come in and have a look at this deal? We don't want to lose the banking relationship. Can you come in and have a look and see if it works? And I think we've done 4 or 5 deals that have worked like that, where a high street bank has come and said, we can't do it. Can you do it? And we've said, yes, we can.
Yeah.
So we're there to complement each other.
No, it's fantastic. Thank you. Well, if anyone has any questions, then just the nature of the LinkedIn Live is that, we can't have people sort of asking questions as we're doing this. But yeah, if you want to put something in the chat, then we can respond, or reach out to either myself or Ben directly on LinkedIn, and we'd be happy to have a chat about anything. So no, thank you so much, and sorry that we've overrun slightly, but no, really appreciate your time, Ben. That's really informative. So no, thank you.
Thank you for having me, Kate. It's been brilliant.
No, that's quite all right. No worries. Take care.